We make choices all the time, pretty much from the time we wake up until we go to bed. Some choices are easy, chocolate or vanilla, fish or chicken, and some are a lot tougher, like how can I grow my long-term savings? How do I take care of my family after I'm gone? What kind of legacy can I leave? In today's world, there is so much information that sometimes it seems impossible to make a choice and a decision on what to do. That's why we're here. Hello, I'm Michelle Suskauer, and this is Insure Wealth, a program that wants to help you cut through the fog of words and data and get to a point where you can figure out what to do. And our guest every week is Howard Kaye, an insurance advisor and expert. Welcome, Howard.
Thanks, Michelle. And you know, you're right on target. In this age of sometimes too much information, a lot of people do nothing because they can't sort out what works for them. I'm here to walk you through some of the possibilities for action in facing some of the most important decisions in your life.
Okay, let's start walking. Many of our viewers want to make sure that whatever they decide to do with their hard-earned savings, that money will be safe. And they don't want to lock up that money so that they can get to it when they want it. And they want to be confident that those savings can grow and that their family and their loved ones are taken care of financially when they pass away. In other words, I guess most people want it all. They want everything. So are they just dreaming?
Well, Michelle, as the saying goes, dreams can come true. Now, as we pointed out last week, there is something that I call the everything solution. That may be an answer for many people at various stages of life. I'm going to explain. It's really pretty clear and simple, but first, I want to be right up front with something. I am not a financial planner or a financial advisor. I do not suggest what stocks you should buy, what percentage of your net worth should be in bonds or gold, or any other financial instruments for that matter. I am an insurance advisor, and I have been in the life insurance industry virtually all of my working life. And I do what I do because I believe I can offer some information that so many people are just not aware of, information that can give them and give you opportunities and advantages that are at least worth knowing about and considering. And I also want to say that people have different situation, needs, and wishes. So for more information for you, 561-417-5883 or online at insurewealthtv.com.
All right, Howard, let's play a quick game of yes or no. I'll give you a word for some of the things people have told us they want, and you tell me if your everything solution gives it to them.
Okay,
are you ready?
Let's do it, Michelle.
Okay. First, liquidity.
Yes. You can have a policy that lets you withdraw money anytime you want without any surrender charges or penalties associated with it.
Safety.
Yes, you can have a policy that both lets you take out monies with no penalty and is safe and not subject to any market risks.
Growth.
Yes, again, you can keep your money safe, get your money when you want it, and get a potentially meaningful rate of return. And as I'll explain in a few moments, when I say a meaningful rate of return, I am not talking about the very low rates of return currently on CDs or money markets, treasuries, or even bonds. What I am talking about are your savings can grow a meaningful way, and there is no risk of your savings losing value or you having to settle for rates like 0.5% or 1% or 1.5%.
Tax-free.
Yes, there's a tax-free death benefit that goes to your loved ones when you pass away. And the interest that you earned that is credited to your account is not taxed if you've never withdrawn that money. Only upon withdrawal will it be subject to tax, but if you pass away with it, it is a tax-free death benefit.
Okay, we're on a roll. Long-term care.
Well, again, Michelle, one more time, yes.
Okay.
In addition to keeping your money safe, in addition to being able to get your money when you want, without penalties or surrender fees, in addition to the ability to grow your long-term savings with meaningful rates of returns, in addition to tax advantages, you can also have a policy that lets you accelerate a portion of the death benefit tax-free to cover qualifying long-term care expenses. I know it sounds amazing that you can have access to your death benefit while you're still living, but it is amazing and it's true.
All right, Howard, those are all great answers, but how does it work? What's behind it?
Well, let me tell you, Michelle, and you, the audience, here's how it works. You make a one-time deposit to fund this policy. Remember something, it is a life insurance policy, but now that I've said that, let's forget that for the moment. You're thinking in terms of putting monies away into a safe environment that can offer you potential returns that are greater than those of CDs, money markets, treasuries, and other fixed instruments. So in this example, like I said, you make a one-time deposit. The amount can be between $100,000 and $1 million. Number two, we talked about liquidity. So there is a special rider attached to this policy which makes your deposit or all of your money available to you at any time that you want without any reason whatsoever. You decide you no longer want this program, you can withdraw all of your money without a surrender fee or a penalty due to that rider. Number three, how does your account grow? Well, it's simple. The insurance company is going to credit you an interest rate. How do they determine what interest rate to credit you? Well, they are going to base it on the S&P 500's index, the annual growth of that S&P 500 index. Now, what that means is if the market is up, if that index is up, they will credit you the interest that would have been earned within that index. But there is a cap. What does that mean? The current cap on how much your account can grow within this everything solution is currently 13.5%. In other words, the amount credited to your account from this growth may be much higher than other safe and secure savings vehicles like CDs, money markets, treasuries, bonds. That's the incredible thing. Cap of 13.5%. Let me just expand on that. If the S&P 500 index is up 8%, you will get 8%. If the market is, or the S&P 500 index is up 20%, again, that cap kicks in with a 13.5% rate.
Howard, this is great, but, and I think the question that some of us may have is, what happens if the S&P 500 index falls and loses ground? What happens to my money then? How much can I lose?
Well, that's what's so incredible. You cannot lose anything. Ladies and gentlemen, hear me very clear. You cannot lose. Your account is protected from market loss. One of the things that most people despise about the stock market, we all love the ups, but we can't stand the thought of losing our hard-earned principal. Well, this policy has a guaranteed minimum crediting rate that protects you during negative market cycles, even after fees are assessed within the policy from administrative charges and cost of insurance charges.
Well, who makes this guarantee?
Well, these are by major life insurance companies, very highly rated, and it's the type of policy that we're talking about, this indexed universal life program. But understand what I've done is taken all different aspects of this policy to create this everything solution so that, unlike most savings instruments, the interest credited to the cash value of your account is not taxed until the money is withdrawn. You have a tax-deferred program here. If the policy is kept through the life of the insured, then the death benefit is tax-free. And that's really the only time that you should be thinking in your mind, I'm buying life insurance. What you're really doing here is saying, I want a solution that it gives me an alternative to my CDs, my money market accounts, my treasuries, my bonds, and I love the returns of the market when it's going good, but I hate the declines. How do you protect me from that? And if, on top of everything, you're going to give me some death benefit to go along with it.
It's like the cherry on top.
Exactly.
So income tax free, I like those words, and that works.
Yes. And you may like this too. The policy allows you to accelerate a portion of the death benefit tax-free to cover qualifying long-term care expenses.
Yes, I like that too. And they can use this approach to diversify their overall saving strategies.
Right, and diversification is extremely important.
Now, how about what they leave to their heirs?
Well, this approach allows them to pass substantially larger assets than what they put in or earned to their loved ones on a tax-free basis.
And it helps them address long-term care needs.
You've got it, Michelle. Also, let me add that the policy also can help executives utilize corporate assets to address key man life insurance needs.
A reminder, for more information, 561-417-5883 or online at insurewealthtv.com. Now, Howard, after last week's program where we talked about the everything solution for the first time, some people asked, am I protected if the insurance company changes the policy or the rider after I buy it?
Well, absolutely. Ladies and gentlemen, you're fully protected. Your contract is a legally binding document, which the insurance company has to honor. So nothing would change for you and the policy you bought, even if the insurance company should subsequently change its product offerings. But remember, even if something did change, all you have to do is get out because it is 100% liquid.
Now, there was another question that people were wondering, come on, there must be some restrictions on when and how I can withdraw my money. The individual said that they always hear and see ads for CDs, for example, that say there are substantial penalties for early withdrawal.
Well, what you should know and what you need to know about withdrawing your money is how to go about it. Well, you may do so at any time. Your money is completely liquid at all times. There's no catch. There's no tiny print that doesn't let you make the withdrawal. It's there for you to use if you choose to do so. And how can it be so? Well, there's a special rider that's attached to this policy. And what it is a waiver of surrender charge option, so that therefore you don't have to pay any penalties or charges to cancel your contract. As far as taking money out and keeping the policy going, the company allows you to take out 10% as a withdrawal each year without disturbing the policy. So for people that want to take income, you can certainly do that. For those that just decide we don't want the policy anymore, all you have to do is cancel, and there is no penalty for cancellation.
So how can insurance companies deliver indexing returns with no downside risk?
Well, it's a common misconception that insurance companies invest in the stock market like many other financial institutions do. Insurance companies do not do that. Instead, they invest in a traditional portfolio, typically of fixed income investments like bonds, mortgages, private placements. Then they use the money that they get from those investments to buy call options on the S&P 500. If the market goes up, the insurance company uses that profit to pay you the interest it owes you. If it goes down and the options expire and have no value, the insurance company doesn't make any money. But remember something, in that case, they don't need to pay returns to the policyholders that year. But in any case, your principal is safe and cannot go down, even if the market loses ground.
Okay, Howard, I could just hear viewers saying, if this is so great, why isn't everyone doing it?
Well, first of all, who's saying that everyone isn't doing it? Most people don't know about this program, what I've called the everything solution. Second, and this is no bragging on my part at all, but maybe I'm a little bit, well, more creative in the sense that I came up with this idea of calling it the everything solution. And I am now on television to let people know about it. And last you ask why everyone isn't doing this, well, as I've said, it may not fit everyone's solution, but I don't know that many insurance people are discussing it. Maybe it's a function of commissions, because this does not pay what the traditional types of programs do. But it's not for me to say. All I can do is give you all the information so that I can educate you and you become more knowledgeable on these subjects that have been so confusing for so many people over the years. For more information, 561-417-5883 or insurewealthtv.com.
Well, they say knowledge is power. And in today's really busy and complex world, that may be truer than ever. 561-417-5883 and online at insurewealthtv.com.
Now, Michelle, let me give you some examples of what this approach may be able to do for you. We're going to take 4 examples of people in different circumstances from the ages of 55 to 75.
All right.
Number 1, we have a 55-year-old gentleman. He's retired. He's done okay in his life, but at this point he's retired. He doesn't want to worry about market ups and downs, and he is not thrilled by the low rates currently being offered in savings accounts and CDs, to name a couple. So he looks at the everything solution. He buys the policy for $500,000, meaning he puts in $500,000 into the program. He now has a big growth potential without any downside risk, and he has all the other advantages of the everything solution that we've been talking about. Just look. In 5 years, for example, he'll be only 60. He will have available to him in liquid funds almost $700,000. That's based on the 30-year historical rate of return of the S&P 500 index with dividends, which was 8.3%. So you can see on the chart, after expenses of the policy, liquid funds of almost $700,000, and his death benefit is nearly $1.5 million, and it grows from there.
It sounds like he gets what he wants, no risk, good return.
Absolutely. Now, let's look at someone who's 60 years old and in different circumstances. This person bought the Everything Solution policy with a $300,000 payment. Her tax-free death benefit after only 5 years is more than $860,000. But now she's concerned about the long-term care, the cost of living, what it will cost at that time. Well, with this policy, she can take out a percentage of her death benefit. So let's say at age 65, she takes out 10%. That's more than $86,000 that year to cover qualified long-term care expenses. Now remember something, the 10% is not of her account value, it's of her death benefit. She can provide herself with additional tax-free funds for her care needs in the future by accessing a percentage of her tax-free death benefit, again, for qualifying long-term care needs.
So her concern about long-term care expenses would be addressed by this policy.
Absolutely, that's correct. Let's go 10 more years to someone who's 70. He's a pretty conservative guy when it comes to his money. He owns annuities, but he's unhappy that it's not liquid. Why? Because typically with annuities, there are surrender charges. It can be 3 years, 5 years, 7 years, 10 years. In his case, it was a 12-year surrender period. And the charges are significant. He is not happy when someone talks to him about more annuities. So what does he decide to do? He takes $1 million and places that into the Everything Solution. He knows it will be safe. He knows there's no downside risk to his principal, similar to that of the annuity, because the annuity is based on an index as well, with no downside risk. The difference being that the upside potential is much lower. The caps are usually between 4 and 5%. Remember, in this case, the cap is up to 13.5%. And what's more important, most important actually to this gentleman, is unlike the annuity with his 12-year surrender period, he can take the money out whenever he wants. He can cancel this program without any penalties or surrender charges. And right away, he has more than $1,700,000 of tax-free death benefit.
Okay, Howard, one of the things you mentioned last week was that someone whose health is not so good, who's not insurable, may still be able to get life insurance through the Everything Solution.
Absolutely. Remember something. Typically, people that are getting into this program aren't looking at it from the standpoint of, I want more life insurance. What they're looking at is, I want an alternative to my CDs and money markets and treasuries and bonds and stocks and so on and so forth. But there are instances where you may not qualify because it is a life insurance policy, which means you must go through the examination process and have your medical records reviewed. So if you are over the ages of being able to obtain this policy, such as an 85-year-old, or in this next example, this 75-year-old woman who is not in good health and she cannot get life insurance, what is she to do? She still wants the ability to make good returns on her money with no downside risk. So, can she obtain this? Absolutely. How? Well, you see, she has a 50-year-old child who is in excellent health. So what's the solution? The 75-year-old mother funds this everything solution for $200,000. But in this case, it is her daughter who is the insured person. The mother, who is 75 and in poor health, remember, it's her money. She will be the owner and the beneficiary of the policy. God forbid her daughter were to predecease her. And as a result of being the owner of that contract, she is the one that gets the tax advantage growth and withdrawal privileges, as well as the tremendous earnings potential. Now, when she passes away, the mother that is, it's so simple for the daughter to continue this program, because all she will do is take over the ownership of the policy, change the beneficiary to her children, and going forward, she will have the same benefits that her mother was able to enjoy.
That's a lot of good stuff to think about. And for more information, 561-417-5883 or online at insurewealthtv.com. Now let me repeat that, 561-417-5883 or online at insurewealthtv.com. Thank you, Howard. Let me tell you that I had no idea that any of these kinds of opportunities existed for me to at least to think about. And this has been a terrific eye-opener for me.
Well, thank you, Michelle. And for more information, again, 561-417-5883 and insurewealthtv.com. So let's just address it one last time. The potential for greater returns than you can in any other fixed instruments, due to the fact that it's based on the returns of the S&P 500 index, annual point to point, with a cap presently of 13.5%. Number two, you have withdrawal privileges. You can take out 10% of your money each year without disturbing the policy with no fees. Or you can cancel the policy at any time with 100% liquidity. Number three, a tax-free death benefit that goes with the policy, so that if you never touch the money, it will go from tax-deferred growth to tax-free when it's passed on to your loved ones. Number four, a long-term care plan included, meaning if, God forbid, you are unable to perform 2 of the 6 activities of daily living, you can access some of that death benefit during your lifetime on a tax-free basis for qualifying long-term care expenses. And finally, the fact that you have tremendous safety, which is most important to everyone. You can protect your principal. You will not lose your principal. It is backed by a major, highly rated life insurance company. And the bottom line is you have upside growth, no downside risk. One last point. There are charges that are associated with the policy and the death benefit. But remember something. Even if those amount to 1.5% to 2% a year, you will find that if the returns are 10% that year and you net 8.5 or 8, that's terrific. If you gross 6%, you may net 4.5. If you gross 13.5%, which is the cap, it may be 11.5 or 12. That is the everything solution.
Thank you so much, Howard. And we'll see you next week when we will give you more information on something that means a lot to you and every one of us, protecting and growing our long-term savings and taking care of our family's financial future. Until next Saturday at 5:30, so long.